Hello and welcome to this edition of TMA's Farm Margin Talk. This is Devin Schierling, Grain Marketing Manager for TMA. So as we look at our profitability post-Valentine's Day for February the 17th, 2012, you'll notice that once again our profitabilities, whether it be in 2012 or 2013, are looking extremely profitable from a historical standpoint. But the key thing I like to point out here is once again we're seeing that difference between corn and soybean profitability continue to ratchet up. That was the theme that we talked about last week on our margin report, and that difference continues to become narrower and narrower as we're concerned about the number of acres of corn we're going to plant and how we're going to feed some of our bean demand going forward. And then when you look at wheat, wheat's had a little bit of a rougher week with about a $31 profitability, but we saw that come back down just a little bit on weeks in. This is just how we came up with that information, showing you for new crop grain prices at Groveland, Kansas, and then each individual scenario that we look at. So we've been talking about the crop insurance base price for the last couple of weeks and how important that is for setting our foundation of revenue future going forward. And so from last week to this week, soybeans have seen a 10-cent per bushel increase, while corn's actually decreased by 3 cents a bushel. So as we sit today, we're sitting at about a 571 average for corn, and for soybeans we're at $12.44. Now remember, volatility has a lot to do with this as well, but we're about 75% through the average as we speak. And so what does that mean to me? So if you're a producer who has dryland corn and you have a 90 bushel APH and you purchase an 85% RP policy without the trend adjustment we've been talking about, you're going to invest about $22 an acre. And if you do that, today you're going to be sitting at roughly a profitability of $112 an acre. And if you're down that low price, low yield category, you're going to be looking anywhere from $49 to $42 an acre of potential profit. So still a great decision and a very safe, good, green is good situation for your profitability. But if you make the decision to use the trend adjustment with your 85% RP policy, you're going to increase your investment by about $15 an acre. But what you get in return for that is fabulous. But before we talk about that, remember that the trend adjustment is highly dependent upon what your yields are, and this is just an estimation based upon an example that we're using today. So if this was your farm, the trend adjustment would actually add 10 bushels an acre back to your dryland farm, and you would now be looking at a guaranteed profit per acre if you grew your APH at $150 an acre. But if you look at this from the low yield, low price quadrant, you're in a situation where now you're at $80 an acre to $72 an acre. And that's a huge difference when you look at what that profitability means to you in those times when you really need your crop insurance to kick in, as well as what that 10 bushels an acre does to your overall profitability. Increasing $38 of net profitability by making the right decision is huge. So as you're making this decision here before March the 15th, if you need some more help on this, feel free to contact us and we'd be happy to help you. As we look at our Kansas wheat conditions, this just shows you where we're at today according to Inform Economics. So the blue line with the yellow diamond in the middle is where we're at today. In the blue line, the light blue line, turquoise, however you want to put it, with the star in it is the average. So as you can see, Kansas winter wheat conditions are sitting just a little bit below average, but yet significantly better than where we were last year at this time. And so with the drought in Oklahoma and some of the rain talk, everyone talks about how Oklahoma is completely out of the drought. Well, according to the Palmer Drought Index, Oklahoma has seen a huge jump, but realize that there's still a -2 when it comes to their drought index, 0 being a normal condition, which is still significantly worse than where Kansas is at to date as well. So this just kind of helps put things in perspective from more of a 30,000 foot view. And this is also another weather chart, and I apologize for talking heavy about weather, but this will all make sense here in a little bit. This is a seasonal rainfall chart as well. So as you can see, the black line with the yellow squares shows you where we're at to date through January, and the red line shows you the max since 1987 of rainfall we've received during this month, and the purple line is the minimum. And we're sitting right on the minimums right now going forward. And the same is true for temperatures. But yet we're sitting significantly higher, judging by that yellow square right in the middle of where we've been since 1987, and especially from climate normal. So as you're making your crop insurance decisions, be looking at these things and how they may affect your operation going forward, and how a little bit of an increased investment today can pay off in spades if our weather patterns continue to be as volatile as what they've been the last couple of years. So what's causing our market to move? Export demand, once again, is playing a big issue. Lack of producer selling. When producers aren't selling and the market needs grain, it's going to force the market to move to acquire that grain. And then continued weather concerns, weather throughout the entire world and how they affect each specific commodity. So for more additional information, feel free to contact our TMA grain marketing or crop insurance specialist. Thank you and have a great day.